politics, people constantly tell me I have no idea what I'm talking about. So I also write detective novels, but we never show those here. So this is the book saying Trump is going to win. These are the inflation books, which need to be updated because they were written in the early 2010s. So, oh, you'll find out. Move to Argentina. You'll see it immediately. Ask this man right here, this terrible Argentinian experience. So it will happen because they're going to just lower interest rates and pump money in the market one time committee, and then it's going to just blow up. And it's starting to rise already. So just wait there for a while. So David's going to update us with his market timing model, and he had a potential top in January, and he certainly talked about that in the January meeting, and the possible top was the next day, right?
Well, we met on the 25th, top was the 26th.
Yes.
Well, the high was the 26th.
We had the meeting on the 25th. We may have seen the top 26th the day later. We will find out. And even if we see another top, it's going to be like very poor quality. I wouldn't like just say, oh, I'll wait and get a few extra cents. It's not worth it. So then I will have a longer talk, and this man will sneeze the whole meeting. He's allergic to my talks. People frequently react that way, so it's not unusual. We're going to look at the sell-off that just took place. And we're going to look at 2 weeks, that week, and what happened the next week. And in some cases, whatever the asset was, it sold off, but then it went higher the next week. And that's very healthy and very good. Now, that's not most assets, it's only a few. So you want to know what those assets are. And a few assets also sold off and then actually went even lower the next week. They are in very bad shape. And you should stay far. No, you walk, guys. This is not the important stuff. Wait till David starts, then we have the important stuff. So, and then a lot of stuff, there was something called an inside week. The trading took place, it was above the low and below the high. And market law says that's very negative. I actually think it's somewhat neutral. I don't think it's that negative. But we also want to see in that sell-off was the 65-week moving average violated. In some cases it was. And we can also tell, we have some interesting charts, where the sell-off originated. It is very, very obvious once I look through a lot of charts. I said, there it is, right there. So lots of interesting things. And I have what assets did better, and you should, if you want to buy something, you should look at those assets and get rid of the others. So David will now speak and say really important stuff. I don't know where your presentation is.
Hopefully, yeah.
Well, that's it. It's almost just do mine again. That's we're gonna need another chair. Do we have a chair?
There's one over there.
Well, I can't sit in bed. No, you have the person has to stand, and
You can move it.
Yeah, we can move the chair. It's got wheels.
Really good.
It's on wheels.
Well, we have one back. Well, let's move. Well, that's for man.
There you go.
A chair in front of him. Better than minus 30-degree weather. Think of it that way. You're getting a very comfortable chair. That's for sure special. Let me see if there's more chairs. I don't know where we will put them. Did everyone come?
Okay, then let's begin. Thanks to everyone for coming along. This is an update on the presentation given January. As Daryl said, the presentation was 25th of January, and certainly the Dow topped out the next day on the 26th. And I'll show you in this presentation the prediction I gave that Daryl just told you about, where I was looking for a top somewhere between the 2nd of January and the 2nd of February. So this is a cartoon I've been showing since about a year ago. At that time, it looked like the Dow was going to push its way up to 21,000. We've got Trump running up the hill with the bulls chasing behind him, and we know from there we've gone a lot higher. We've gone 22,000, 23,000, all the way up to 26,616, which is the high on the 26th of January. But I do think that we're going to, there's a lot of bad news about over the last few months, certainly since Trump took over. We actually did get some legislation with the tax changes. The hurricane season is off now, but there was quite a lot going on through last year, yet the market still rose higher. It was very resilient. But I do think, and I have thought for the last 6 months or more, that we would see a correction, and we've seen that now. And I do think there's a chance we could go a lot lower, to 20% lower. That would be a bear market, and even as low as 20 to 29%. And I'll show you historically why, looking back over the last 100 or so years, why those percentages are possible targets. So going back to when I started doing these presentations, 2014, there was a particular signal we got. This is a weekly chart of the Dow. Got a signal in June that year. It's a reliable signal. Tells me that a top of some kind is coming. Usually the top is on average around about 9 months after that signal. And so what I do, I calculate using some mathematics, probability or opportunities of where a top is likely to happen. And they come in the form of windows or windows of opportunity that are usually 2 to 4 weeks wide, sometimes a few months wide. So 1, 2, and 3 were all just a few weeks wide. Window 4, those actually end up being 4 months wide. The red boxes there are calculated from the weekly chart. I also calculated a couple of windows on the daily chart, called those A and B here, and where B and 4 overlap seemed a pretty high probability that we get some kind of a top forming. And if we roll the chart forward, we do see a top did form in May of 2015 on the Dow. Going back, and then it came down into the late part, so we had a low. I think that was a flash crash in the August time frame. Came up and then came down again, and traded in a range for a while before it took off towards the election. Going back historically, using that same technology and the same mathematics, I didn't have the mathematical model around in the year 2000, but if I roll the maths backwards and run the model through 1999-2000, I got the same similar signal on the weekly chart just before the end of the 1999 year, and that allowed me to calculate 3 windows of opportunity, and the top, which was January 14th, I think, 2000, that formed in the first of the 3 windows. Notice we had a very severe drop before the top, 1,400-point drop, similar to what we've just seen. I'm not saying that that's exactly what we're going to see, but if we look at this top here, and we see the next one, which I'm going to show you in 2007, we do see a sudden drop before the final rise up to the high. Let's look at the same analysis now at the 2007 top. So in 2007, we got a signal in May on the weekly chart of the Dow. 3 windows could be calculated, and this time it was the middle window of the 3, and it formed on, I think it was October 9th or around about there, 2007. And again, we saw a drop of 1,500 points happen immediately before the top happened. So at the moment, we're looking at what's happening in the markets now. The severe drop we saw just recently could be a similar sort of drop just for the top, or it could be the beginning of the top happening. So if I go back to current time then, or certainly the last few years, this is where we were beginning of 2016. Market rallied up to the end of the year and the election, and rallied further from there. We had a daily signal that a top was coming in February of last year. We then had a signal in March, but that actually cancelled out just before the signal fully formed. And then we had to go a little bit further before a signal formed in June of last year. And again, that's a pretty reliable signal. It's on the weekly charts, and usually a top will form somewhere on average around about 9 months after it. So from June last year to March this year would have been 9 months. So somewhere around about March would be a good time for a top to form. And if the top formed in January, that's close to the March, so the average of 9 months after the signal in June. So moving forward through 2017, we actually had a signal on the NASDAQ and the S&P 500 follow on afterwards, also in June. And then later on in the year, there's a huge increase in volume during last year. We had a signal, if I just rattle through a little bit further, we had a signal on the Russell. So we then had the Dow, the NASDAQ, the S&P 500 and the Russell. And when we got all of those 4 signals happening, that means we're getting very close to some kind of a higher, a top form. So this is where we were October last year, and I calculated some more windows, 9, 10, 11 on the weekly charts, and then E and F on the daily chart, and where they overlap, which are these purple windows. So January 2018, that ran from January 2nd to February 2nd. A very small window of just 2 or 3 weeks, end of February, beginning of March, we're about to go into that window. And as we see, we're seeing a slight spike up at the moment into that window. And then later on in the late spring, early summer, from May to late July, another window where window 11 in red and F in blue overlap. At the time I'd said that we might see some kind of a jagged move up into the first window, then the second window, and possibly the third window, not sure where the top would form. And if we roll forward, this is what we've seen happen from the last meeting into this meeting. So the top was the, as I said, the January 26th, which is the day after the last meeting, and it dropped down 10% in the days that followed. So we've got this spike up into the second purple window. It doesn't seem to have enough momentum to get up there, so that may not form a new high, but it's potential that if the current prevailing situation is favourable, we might end up going for a slightly higher high in the spring, early summer time frame. That would be May, June, July. Don't quite know whether that's going to happen yet. It could be that this high on the 26th is actually the top. And certainly the characteristics and mathematics of that curvature are consistent with it being a top. So I wouldn't be surprised if the market goes down from here and doesn't go any higher. Looking at these two signals, the daily and the weekly chart signal on Dow, those don't happen very often. Going back, I've got data back to 1885 on the Dow, so about 130 years, maybe a little bit more, and I back test everything I do back that far. So looking at these two signals together, so usually we'll get a daily signal or a weekly signal, but to get the two together, these are the times, it's only really happened 14 times in the last sort of 100 years or so. And if we look at all these, you get some smaller drops of 12%, we also get some larger drops of 50, 55, 40%, and even down there, 90%, which was the Great Depression. So let's have a look at these. So the two big drops we saw in recent times, 2000, 2007, are in this category. The large crash in 37, and then the drop of 90% in 1999, and shortly after that drop of 90% during the Great Depression, about 5 years later, in the late 1930s, the market dropped again by 50%. So we've gone through one of the worst drops in history, the second worst drop in history just recently after the Great Depression. Looking at a couple of other models I have, one I've built which identifies the potential for a flash crash and also sudden waterfall drops in price. The model kicks out a number of dates for where these particular events can happen, and when I ran the model back a year or so ago, I got a signal in 2010 May and also in August 2015. Both of those were the cases where we got flash crash in the markets. And the other cases where there weren't flash crashes, there were sudden drops in the market, highlighted by the model. Running that model forward, in early 2016 we had a signal in January, and the market did drop suddenly then. And then since then, the market has rallied consistently through the last 2 years. And where we find ourselves now, which is here, we've got signals in the early part of this year, January and March. They're signaling that potentially, where we are now, we could see a flash crash. Not certain, but we could either see a sudden waterfall. We already saw that at the beginning of this drop. But the fact we've got two signals, we might see a further drop down as well. Taking that same model, but looking on a longer time horizon, it starts to then predict bear markets and also US recessions. So this is the model run on a larger time scale. We see signals in 1987, 1988, just around the time of the crash. 1990, there's a drop then. 2002, so that large drop from 2000. And then lots of signals in that very severe drop, 2007, 2009, and again in Q4 2015. Looking at just the most current time frame here, this is the last few years. We've got a signal in Q1 of this year, Q2 of this year, and then Q2 of next year, rather. So those signals there suggest that we could see a fairly severe drop. And I'm not going to show it today, but in previous meetings I've shown that a kind of US recession is due. We've gone almost the longest in history without a recession. The longest ever is 119 months. That happened between 1991 and 2001. And we're now at around about 102 months, so we're about a year off the record. So the record only gets beaten very rarely. So over the last 150 years, it's only been beaten about 4 times. So it's unlikely to be beaten. So between now and 119 months, which is May 2019, it's likely a US recession will start. Not guaranteed, but likely. Looking now at a model from the St. Louis Fed, which looks at US recessions. We've had that signal come on and off over the last few months. There was a risk back in the April report for data up till January last year. More recently, there was a risk in the November report for data up to August last year. The January report had no signal, and the February report had no signal. So whatever the model was picking up back a few months ago is dissipated, but we'll be watching this over coming months. This is the output of that model. I take it from the Fed and I run it through a bit of analysis and show it on a spreadsheet, an Excel spreadsheet. So this is where we were earlier, middle of last year. We got those risk and alert signals there, which suggested that something may happen. They don't happen too often, but as we move forward, they've dissipated. And this is the the February report for data up to November, and those risk signals have dissipated. So currently, no specific threat, but they could build up. So we'll monitor those over the coming months. Just to see what this looks like during a recession. This is the same model run through 2007, 2008, 2009. Just a number count on the left here. This is the time the report comes out. That's the probability that comes with the report, and that's the date that the data is good for that report. There's usually a delay of about 3 months, so August through to November, September through to December. Signal there, that comes from the NBER, National Bureau of Economic Research, I think it is, and they every month they will signal whether there is a recession or not. So that's the value that I'm trying to mimic or model. Then I've got a risk, an alert, and a warning, so escalating levels of concern, and finally a US signal, so that's the final signal I create beyond these warnings that should match this value. And in fact, at this point, I matched it 1 for 1. So for each of the outputs from the NBER, I got a signal saying that yes, there was a recession on.
David, can I interrupt for a second?
Yeah.
I'd like to point out, we actually predicted a recession was starting December 2007. Notice the NBER knew nothing about this. And the news at that time, when the Fed meeting in March of 2008, they were discussing how they could avoid a recession starting. One had already started in December before, and they didn't even know it. So don't expect the Fed actually knows when a recession starts, and the NBER actually said the recession started 1 year after it actually started. It was like, maybe, oh, okay, so they are not a leading indicator. They're not even a coincidental indicator.
And what I'm hoping is, as a recession starts, not that anyone wants a recession, I'm hoping that we can capture that in real time and show this as part of this modeling.
Can I ask you a quick question before you leave this? At what point did the stock market start going down? Did it start going down after the first recession signal, March 2008?
The top was in October 2007, so it's actually just off the chart.
So the stock market's actually a leading indicator, and this
Yeah.
is a lagging indicator. Okay.
Yeah, because they're
Sometimes
looking at
it's super
cycle
lagging,
changes.
actually.
So they're saying that the business cycle is changing at that point. The business cycle isn't necessarily the same as the stock market.
Because the market was going up at the last recession signal. The market was already going up by then, wasn't it?
Yeah, so the market started going up in March 2009. That was the bottom. The recession, according to the NBR, carried on. And again, it's the business cycle they're managing. They're monitoring, not the actual stock market. So the business cycle and the stock market are related, but they're not the same.
Mm.
And then at the bottom there, I've got a little flag that I generate. It looks at the rate of descent of the probability as the recession is ending, and it gives you a little warning, not even a warning, it gives you an alert that the end of the recession is coming, usually about 1, 2, or 3 months during the final few months of the recession. So we should be able to see that happen. And the overall model that I've built there off the Fed data is about 98.5% accurate, which means that over the last 50 years, it gets 98.5% of the data right. So that's a fairly good level of accuracy, and I'm happy with that. So we can monitor this month by month going forward. Another model, but this time from the Atlanta Fed, I look at is GDP, quarter by quarter. They produce this several times a month, and it's an advance warning for what they believe the GDP value is going to be. Going back to Q1 last year, their prediction was 0.2%. It actually then, through the advanced preliminary, and then the final value came out as 1.4% final value. For Q2, their prediction was 2.8%. Advanced was 2.6, then 3.2, then 3.0, 3.1. That was the final value. Q3, this is what we've just gone through recently. Their estimate was 2.7, and their final value is 3.2. So we had a couple of quarters of just about 3% GDP. And this is where we are now for Q4, just gone by. Their estimate was 3.4%, and the advance on that is at the moment 2.6%. I don't think we've got any more. We're still waiting for the next few values on that. That'll come out, I think, the end of February and the end of March. And then just for Q1 that we're in now, their estimate is 3.2%. Yeah, that's right. That's what we're seeing at the moment. So they're estimating around about 3. There's a big spike up to 5.4%, but it's quickly come down as new data's come in. Looking just at the VIX in this section, been following this for the last year or so. We saw a downward pattern, phase 1, phase 2 change, and then a phase 3. This phase 3 has been going on for quite a while now. With phase 3, I'm always looking for a confirmed 13 candlesticks following a set of rules that comes with this particular model. And we've come a long way on the VIX and seen lower and lower values, and we've actually seen some historically low values. The VIX started around about 1990, and as we go forward, here we are, end of last year, and then here we are, actually just before we go. So the very low value we saw, the lowest since the inception of the VIX, 1990, was 8.56. VIX is always the opposite of the market, so a very low value in the VIX is telling us the market is doing something that's very toppy, because the VIX and the stock market, the S&P 500, they move opposite to each other. So the fact we saw such a historic low there is telling us something like a top is forming, more than likely. And we saw successive lower lows right through until it was November 24th, last year. And then we suddenly got this spike up in the VIX recently as a result of the drop in the markets. And it's brought the scale of this down. But we might see the VIX settle down a little bit before, and then spike a lot higher if we do see a severe drop in the markets.
Can I ask a question about the VIX? My impression was, they said on Bloomberg, is that once the VIX starts, it went back many years, and once the VIX starts peaking up, it's similar to like an earthquake. Like the more it starts shaking, the more likely that there'll be an earthquake. Like the more.
There might be an earthquake, but we're not
the higher the VIX gets, it's like similar to. More likely there'll be an earthquake. It's like more.
I would actually say that the extreme low there is probably more likely a signal that something bad's going to happen.
Sorry.
I think that the extreme low there, which means the market's an extreme high, that's more a signal that something bad is going to happen.
Oh.
But the inevitable consequences of that low is it's going to spike up. It might spike up several times. But if we see a 20 to 30% drop in the market, this is going to go a lot higher. It'll go up to 100 or more. So this is just the beginning. If we're right and the market's going to go down from here, that eventually will look quite small on the scale. It will go to double that and higher. If you go back,
it's just been so low for so many years.
Yeah, it has. Yeah, there's been low volatility as the market's just marched on with few changes.
But how is that low point more indicative of a drop than the other low points?
Because that's historic. It's the lowest point in the history of the VIX.
Oh.
So going back to 1990, 8.56 is the lowest value it's ever had. Question at the back.
What about in terms of the highest value? I think the highest value was during the 2008-2009 bear market.
Yeah, it went up to 100 or more. I mean, do you remember what it was?
No, but 100 was more than 100 even.
Yeah, 100, 150, I think
Do you think
it
it will
went
match
to.
that or will actually exceed that?
Well, the thing about 2007, 2009, it was the second worst drop we've seen in the Dow, in the history of the Dow, because the Great Depression was the worst. We may not see a drop of 55%, which we saw then. We may see something less. So it may not go to 140, 150, it might go to 100, 105, 100. Difficult to say, and I don't know if you can actually match level for level, but it could go probably higher than that, I would think. I've been looking, I haven't changed this from last meeting, but looking at, I've changed the 10-year Treasury notes yields, but I haven't changed the high yield junk bonds. Let's look at these very quickly. So back in 2014, when I started doing presentations here, I said that we had seen a bottom in 2012 in yields of the 10-year note, and we'd probably see another bottom, a double bottom, or maybe slightly lower, and that's exactly what happened. So that was the prediction there. 2012 went down to 1.39, and then just in 2016, so 2 years ago now, a little less than 2 years ago, it went down to just a little bit lower. Reasonable to say that's the double bottom, and that might be the lowest we see yields in the rest of our lives, as yields start to climb up from here. Or it may come down and form either a triple bottom or a lower low. We'll see what happens in the coming years, but it seems to be coming to a low point. And as Daryl will tell us, we've seen negative yields around the world for some period now, and that's indicative of the fact we're at some point here where the bond market is going to change direction, bond prices will come down and yields start to go up. So just moving on from that point there, we've come up quite a long way, and yields of the 10-year note and the other bonds have been on the news recently as they've peaked up 10-year around about 2.93%. So they're on the climb. However, if the market does deteriorate, the equity markets, then people potentially will flood to bonds as a safe haven. As bond prices go up, as people buy bonds, the yields come back down again. So there's potential, there's a drop in the equity markets, it may come back down and either retest that low or go lower. So yields may come back down again. I haven't changed this chart from last week, but we'll continue to monitor it. It's something that Daryl has made us all aware of, that the high yield junk bonds is an indicator of bad things happening. So when they start to come down severely, it usually means that something's going on in the equity market. I'm just monitoring the phases there. We had from the bottom in 2009, the phase 1, phase 2, phase 3 change, and then we started to see a drop coming down into 2016, and then back up again in 2017. Currencies. This was a long-term view back a few years ago of the dollar. And I noticed that there was an increase in the dollar during the 2000-2002 recession drop. There was also an increase again in 2007-2009. So it's potential that we could see another rally. And we did actually see that as we look forward in the future charts. And the question is, what happens to the dollar going forward? It's come down a lot in the last year, but it may bounce back up again.
Is this the dollar against the yen?
This is just the dollar. So I think it's just a dollar representation.
It's
so
a trade weight.
Yeah, not versus anything
Against
specific.
a basket of currencies.
Oh.
So just looking at that last period there, this is what it is closer up. We saw that rally. We've actually got a particular pattern here: phase 1, phase 2, 9 candlesticks, and then phase 3. Phase 3 got to candlestick 8, and that usually will continue on to 13 candlesticks. And therefore I was expecting the dollar to take a breather at that point, come down and maybe back up, and that's exactly what it did. It came down. But it's actually come down even further, so this is where we are now. It hasn't bounced up the same way as I thought it would, but potentially the dollar could get stronger if we do get a recession and climb back up again and retest the highs. The euro, which we're going to move on to next, is the mirror image of this. So we've got phase 1, phase 2, 3, but in the downward direction. And I thought the same would happen. It's a mirror image. A bounce up with the euro, and then bounce back down again. So we've seen that bounce up, and it's done exactly the same as dollar. It's gone up outside the range of the boundaries that I've set, but it could easily come back down again if the equity market deteriorate. Looking now at Bitcoin, we've been watching this since early to middle of last year. The phase 1, phase 2, phase 3 change there. The RSI value above 80, which is significant, shows that more than likely Bitcoin was in a bubble at that point. I couldn't run the model I normally run on it at that stage because I need about 4 to 5 years of data, and there wasn't 4 to 5 years of data because Bitcoin is so new. But more recently, as data's come through, I've made some assumptions and run the model, and it does show that the Bitcoin is in a bubble. and we saw the price of Bitcoin come up into November with a sharp spike up there, and I said at some point it may come back down, or come down severely, and that's what we actually saw. We saw Bitcoin come down into the end of last year and come down lower as well. So that's where we are back a few days ago. I think that was Sunday or Monday that I took this data. So it's a fairly classic view of a bubble, a spike up, and then a spike, a drop back down again. Now my predictions are that potentially we could see a spike back up again, either to new highs or to retest that high. But eventually, if this bubble is to burst and follow the normal pattern that a bubble follows, it could drop as much as 90%, which means it would come down to about this range here, about $1,000 to $500 a Bitcoin. So that's as low as it could go.
Do you still think that it can go back to that 20,000 range back again? Or?
Possibly. I'd see that window 3. I'd said between February and April, there's a window of opportunity where it could bounce back up again. Because if the interest spikes, you can certainly get in. It's a weekly chart, so these candlesticks are a week's worth of trading. So we could see just in a few weeks a spike back up there to either retest it. It might fail the test, or it might go higher. But the model I have suggested that window 3 is a potential for a lower high or a higher high. But eventually, once people start to sell in large numbers, they've already done that during this sort of downward move. But as long as once the selling starts to build up, then 500 to 1,000 is a price that I'd be thinking it would go down to. All bubbles need to reset and deflate properly before they can rise again. And the selling, once it starts to really build up, usually brings it down to a certain point. And this type of bubble would normally drop 90%, and that's about the level it should drop down to, about $500.
And the same is true for the rest of them, right? The Ethereum, Litecoin, and all.
They all come down. I haven't analysed them in the same way, so I don't know how far they'll come down. But yes, I think the same would happen to all of them. A lot of the markets are either in a pre-bubble or a bubble stage. So the equity markets are not in a bubble here, but they're in a pre-bubble state. Places like Argentina, which we'll look later, that's in a bubble. Venezuela's in a bubble. Bitcoin's in a bubble. Stocks like Facebook, Amazon, will show those, they're also in a bubble. So there's huge bubbles forming, and they all have to crash. So actually, this is the stage you're looking at now. So 8 stocks, going back a year or so ago, there are 8 stocks in the Dow, so it's over a quarter of the Dow. We're in some form of a bubble. I've focused in on Apple recently. This is a company called 3D Corp, Systems Corp, and that's a typical bubble. Straight up 1,000%, down 90%. But some bubbles actually look a little different. Apple's actually what's called a 3-peak bubble. That's quite rare. So we had a peak in 2012, a peak then in 2015 when I started getting interested in it, and I predicted that bubble. So late 2014 I said it was going to crash, and it did. And it's risen back up again and formed a 3rd peak. But this time this looks like the end of the pattern. I don't think we'll get a 4th peak. So and there's a particular rhythm here. There's a 2012 point, 2015 point, and the top at the time we started looking at was 2017, but I did say it might go in 2018, and it has done that. So we got this 3-year pattern. So we had a bubble peak there, another bubble peak there, and another 3 years on. So I think that possibly Apple has got to a point where it's not going to go much higher, and it'll crash a fair amount, but it's consistent with a rather rare form of a triple peak bubble. This is it closer up in Apple, so just skipping through, here we are, and you see it's come down along with the market a fair bit in January and February. The reason why I've been looking at these particular stocks, looking at Apple themselves, look at some of their financial numbers. This is net income. You see this exponential curve upwards, and actually then 2012 they had an issue. That was the 2nd peak, and their net income started to level off at that point, and that was consistent with the first peak of the 3 peaks, 2012 rather. And from that point, the net income has changed, but really on average it's really stayed around about 44. So that they haven't really grown in the same way as they did in the first point. So looking at this particular curve here, then we'll look at a few more stocks. So look at I've been monitoring 18 other stocks. There's probably many more, but the ones I've identified, FANG stocks, Facebook, Amazon, Netflix, and Google, biotech stocks, and then other stocks as well. So 18 different stocks that are in some form or have been in some form of a bubble. But looking specifically at the FANG stocks, Facebook has got this curvature upwards, and then looking at advertising revenue, they've got the same curve upwards, and that can't go on forever. That will burst at some point. Amazon, same sort of thing. They're in a bubble, and they've got the same curve upwards for their net revenue. Netflix as well, same curve upwards, and finally Google. They're in a bubble, and they've got this curve upwards, and that curve, as it goes up exponentially, eventually gets to a point where it has to topple over and crash. Just looking at the last few asset classes, and so we'll look at Japan, China, South America, and then a couple of commodities. So Japan came down from the high in mid-2015. It's actually bounced up higher. It came to a resistance point in middle of last year, but then has pushed higher and then come down quite sharply in the downturn we've seen in a number of asset classes in the last few days and weeks. This is China. We predicted that China was in a bubble middle of 2015. It was going to crash, and it's crashed a long way. At the point where we were at the end of 2016, I said it probably still had at least another 1,000 or so points to fall, and it did quite quickly do that down to the dotted line. The dotted line there is the point where it needs to go below that to fully deflate. If it doesn't, eventually it'll get there. It'll have to go down to that point to fully deflate. And that's because all bubbles go through a particularly determined life cycle, a particular mathematical pattern. If they don't go through it, they can't deflate properly. China's stock market has kind of meandered on for the last 2 years, almost sideways. Same sort of resistance line there as we saw in Japan from the end of 2015, and this is where we are now. It came up, still not quite the resistance line, it's come down sharply. But from that point, I still think that's about I think about 10 to 15% drop, 10% drop. I still believe that there's a 30 to 50% drop likely from that high point there for China, and I'll explain that quickly now. This is a long-term view of China. You see a bubble that formed in 2007 and the crash that ensued. We just saw that bubble in 2015, a couple of years ago, and that's crashed. And I calculated that 100% of bubbles will go down below this particular mathematical level here, based on this bubble here. And 95% will go below this line, so there's very few actually end up in this line, but then 35% will go down below this line, so a full 60% end up in this area. So there's a sort of concentration of deflation for a bubble down to this region here, which I work out using a particular mathematical formula I developed. So for that reason, I expect for those two red arrows that China is going to come down to probably this line and probably down to this line or lower, and those are 30 to 50% drops. So this was something I calculated April 15th, 2016, and that hasn't really changed. So if we move forward to end of 2016, similar sort of calculation was still available, and because it's trended sideways for the last 2 years, even in June last year, same calculation was still true. And where we are now is just sideways of where we were. I need to do this calculation again, I'll do it for the next meeting, but we're still at a point where I'd expect a 30 to 50% drop before China can fully deflate the bubble it's been through. This is Argentina. Again, that's in a bubble. It's been, that's the 18,000 point back in 2016 to early 17. And we watched that point go lower and lower as it's charged higher. And that's where it is just a few days ago. So it's gone a lot higher, but it's in an exponential curve, it's in a bubble, and Argentina will crash at some point, come down quite severely. One of the reasons why they've got a problem there, if you look at the currency, back 2009, they were at 3.5 local currency to a dollar. And then more recently it's been 17.8, which is about a 500% increase. In fact, more recently it's gone up to 20 of the local currency to a dollar, which is about almost a 600%, certainly 571% increase. That's part of the problem they're dealing with. We're seeing the same problem in Venezuela as well. If you look at the Venezuelan stock market, they've also had the same thing. That's where we were back early 2017. They've had a massive bubble there, one of the largest bubbles I've ever looked at. And it's just gone up and up and up and up. So this is where it was. They've changed the valuation of the index, so the chart doesn't work anymore. So that's where I have to stop showing the chart. Same things happened with their currency though. They were 2 local currencies to the dollar back in 2009. They've been up to 10, and then more recently 11. So again, around about the same 500% difference between the local currency now and where it was against the dollar back 6 or 7 years ago. Same sort of problem they have in Argentina.
Why did their market go up 10 times? Could I see that before again? That with their market
Why did it go up 10 times?
Well, like
It's
from
gone up-
50,
It's gone up more than 10 times. It's gone up.
from 50, like from 50,000
I'll
to
show you. Let's go back to where it was originally. I mean, going back not too long ago, just the last couple of years ago, it's down at 5,000, maybe 10,000.
5,000.
It's now gone up. Then it went up to 500,000, and it's actually gone double that again just in the last couple of months. It just keeps doubling. When
What
when's the
is going
exponential?
on in the stock? Why is apparently in the stock market like that?
Well, the country itself has got problems because of the price of oil coming down the last few years. They've also got political problems. But you just get this hyperinflation type situation where the stock market valuation just goes up and up and up and up and up and up. And it's insane because it doubles every few months. So it's going like 1,000, 2,000, 10,000, 20,000, 100,000, 200,000. Just keeps going up insane levels.
What I meant was 10 times in the last few months. That's what I meant, from 50,000
Yeah,
to 500,000. It's just people are chasing stocks as a means of safety, or
I'd read an article about it, not so much of it a means of safety, but it's just to keep up with their investments, I think.
oh,
Because it's going up so quickly, but once that crashes, it's going to come down again, 90%, it's going to come right back to zero again.
oh.
Let's move forward. I've just got a few more to cover. Oil, and a couple more things. So this is oil. We had a drop down 15, sorry, then a low in 2016. Oil has meandered along the bottom for quite a while now, but it has started to rally, and it seems a reasonably good rally at the moment. We'll see what happens with oil over coming months. If there's a recession, demand for oil may go down. We may see oil price come down a little bit. Let's get through this chart here. This is just something that I've been analysing on the weekly chart. And it shows the same as we saw before, just see that rally up. And it seems to have a certain amount of strength at the moment. This is oil on a monthly chart, showing the downward turn from 2014. And I'm looking on this chart for phase 3 down to candlestick 13. We actually got to candlestick 12. And we're looking for candlestick 13, and it's slowly moved up. And here we are now in February, but we haven't quite got that last candlestick, so I'm still thinking that maybe we'll see a drop down before that full cycle ends. Gold, we saw a golden bubble way back in 2011. We saw the same in silver. The market's actually dropped down almost 50% since that bubble collapsed in gold. Just looking at the last few years, gold came down, formed a low in end 2015. It's bounced up since then. And here, this is where we are now, February 2018. So it's kind of been in a range with some erratic movement. But the question is, if we do see a downturn in equity markets, people will move into gold as a safe haven. So we might see a fairly strong rally in gold if the equity markets start to deteriorate. This is a monthly chart of the gold. Again, like oil, you see a phase 1, phase 2, phase 3 in the downward move, and we're looking for a 13th candlestick, which we haven't quite got yet. We've got some unconfirmed marked with an X, but they need to go down below this area here before it can be a fully confirmed 13th candlestick. So potentially we could see gold dip down again before it rallies up. Last few assets now, natural gas, long-term view, see this very strong decline in natural gas over the last few years from 2008. Just looking at the last couple of years, saw a low in 2016 and coming down to form a new low there just in recent months. Copper's actually bounced up quite a bit. Copper's come up. This is where we are now. Come up a fair bit from the low that it formed in early 2016. Coffee, that's continued to go down. This is a long-term view, and if we look at the last few years, formed a low in 2016, it's come down lower than that just in the last few months. There we are in February, just this month now. And then uranium we've been following as well. That's a long-term view, and we saw the uranium price meander down, and it's come down quite significantly over the last couple of years and formed a double bottom. So it dropped down 40% to 36% from back a couple of years ago. Bounced up end of last year, end of 2016 rather, into the beginning of last year. Come down through last year and then bounced up again. But it's come down again in the last few months. So I'm not sure it's going to come down and form a triple bottom before it finally starts starts moving up. Final asset class to look at then is DVC, which is an ETF commodity based on 2 oils, 2 agricultures, and 2 metals. And we've seen that meander over the last couple of years, along with the price of oil, moving sideways in a range. And at that point, we're looking to see whether end of last year it's going to break out on the upside or the downside. We've seen it break out to the upside, and here we are now. Now, is that a full breakout and it's going to go to the upside and continue, or is it going to come back into that range and maybe even go down? Difficult to tell at this stage, but it's been in a range along with oil for quite a while. Okay, that's it then. If you want to be on my distribution list, come and give me your name and an email address at the break or after the presentations, and I'll take your name and email address and put you on the distribution list. But thanks very much.